Welcome back to the Deep Dive. It is Tuesday, February 3rd, 2026. And if you've been watching the market today, you know exactly what we're talking about.
Oh, yeah.
Chipotle dropped their fourth quarter and full year 2025 results this morning. And frankly, the market reaction is telling a story that the headline revenue number has to hide.
It really is. On the surface, you've got a company that looks like it's, defying the economic gravity we've been feeling.
Right. I mean, you see them everywhere. I feel like I passed three just walking to the studio. But when you actually crack open this report, the health of the burrito empire looks, well, very different.
It's a masterclass in conflicting narratives. You have record-breaking revenue sitting sort of uncomfortably right next to shrinking foot traffic.
That's it.
It's a growth story, but the growth isn't coming from where you'd think.
That is the perfect setup. I went through the release, and the first thing that struck me was just the sheer disconnect. You have the top line, and then you have the unit economics.
Yeah.
We're looking at a company that's getting bigger physically, but the actual demand per store is leaking. So let's strip away the corporate gloss for this deep dive.
For sure. And we can't ignore the macro context here either. I mean, this report explicitly cites the impact of tariffs enacted in 2025.
Which we've been waiting to see show up in the hard numbers.
And it's finally here in black and white.
Exactly. So let's start with the cash, the big shiny number. Full year 2025 revenue hit $11.9 billion.
A huge number.
That's a 5.4% bump over the previous year. Q4 alone was $3.0 billion. If you just stopped reading there, you'd think, great, business as usual, pass the chips.
But you can't stop there because the comp sales,
Yeah.
they tell a completely different story.
That's where the whole thing falls apart, isn't it?
It really is.
Oh.
While total revenue is up, comparable restaurant sales, which are the vital signs of the existing stores, were actually down 2.5% in the fourth quarter.
Down.
And for the full year, they dragged down 1.7%. That gap between total revenue growth and negative comps is, it's alarming.
It means the entire revenue increase is being manufactured by construction crews, not by, culinary demand.
Exactly. It's the treadmill effect.
Yeah.
They're running faster just to be in the same place. If you strip out the new store openings, the business is actually shrinking.
And the transaction counts prove it. It's not just that people are spending less, they just aren't showing up. Transactions were down 3.2% in Q4.
That is a significant erosion. Losing over 3% of your traffic in a single quarter is not a blip, it's a signal. A signal that your value proposition is being seriously challenged.
So how is the revenue up then?
Well, they pulled a couple of levers. They had the benefit of menu price increases, which boosted the average check by 0.7%. But that clearly has a ceiling.
Right, because people are voting with their feet.
They are. And speaking of pulling levers, there was one line item that honestly made me do a double take.
Let me guess. The gift card breakage.
You got it. I saw they recognized $27.0 million in revenue from breakage in Q4. That is up $19.1 million from the year before.
To me, that just looks like accounting gymnastics to save the quarter's appearance.
It is a very convenient windfall. For anyone who doesn't know, breakage is basically the company saying, hey, a bunch of these gift cards we sold will probably never get used.
Lost in a drawer somewhere.
Exactly. But for it to spike by almost $20 million year over year,
Yeah.
that's unusual. It suggests a change in how they estimate that, or maybe a huge batch of old cards just expired.
But think about it. That $27 million flows straight to the bottom line with zero cost. They didn't have to mash a single avocado to earn that.
Right.
If you back that out, the revenue miss would have been glaring. It feels like a one-time sugar high.
You absolutely cannot build a growth strategy on people losing their gift cards. And the report even says this breakage does not impact comparable restaurant sales, which is technically true, but it softens the blow of the total revenue picture.
It masks the weakness.
It masks the operational weakness. When your organic traffic is down 3%, banking nearly $30 million in free money is a lucky break, not a business model.
So the top line is being propped up. Let's look at the expense side, because this is where the 2026 reality really bites. Operating margins fell to 14.1%.
Down from 14.6% a year ago. And this is where that macro environment comes in. They cite inflation in beef and chicken, which, we expect.
That's that everywhere.
But the specific mention of tariffs enacted in 2025 is the real key here. We've moved from like a theoretical discussion about trade policy to seeing it hit the P&L of a burrito chain.
It's interesting they called it out so specifically, isn't it? They don't break down what's being tariffed. Could be equipment, packaging, who knows. But the fact that it's listed right alongside beef inflation tells you it's a material drag.
And it squeezes them in a way they can't easily fix. If their costs go up, their usual move is to raise menu prices.
But they can't.
But we just established that transactions are down 3.2%. They just don't have the pricing power they had a couple of years ago. If they pass those tariff costs on now, that traffic decline could accelerate to 4 or 5%. They're stuck.
And the biggest cost of all is labor. It rose to 25.5% of revenue. That is a massive number.
It is. The report mentions wage inflation, which is standard, but also sales leverage.
And that goes right back to the traffic problem, doesn't it?
Precisely. In the restaurant business, sales leverage is everything. You have to have a certain number of staff just to open the doors.
A baseline crew.
Right. A griller, someone on the line, a cashier. If you sell 500 burritos, that labor cost is spread out nicely. If you only sell 400, that same labor cost eats up a much higher percentage of your revenue.
So their labor is getting more expensive even if they aren't adding any more people.
That's it. Which brings us to their big plan, the recipe for growth.
Right. CEO Scott Boatwright's 5-pillar plan to turn things around. But reading through it, core, brand, modernize, global, talent, it feels like there's a huge internal conflict here, specifically between modernize and talent.
Oh, for sure. It's the tension of the decade, really.
Yeah.
On one hand, they talk about talent and cultivating agility in their people.
And on the other hand,
The modernize pillar is all about AI and a high-efficiency equipment package. When you're running a 25.5% labor cost, the efficiency they're chasing is almost certainly about reducing human hours.
right. They mention using AI to improve accuracy and speed. We know they've been testing those automated guacamole makers and the new grills.
The dual-sided ones.
Yeah. When your transactions are down, you stop hiring to meet demand and you start automating to protect your margins.
And that risks eroding the customer experience even further, doesn't it?
Hmm.
The core pillar talks about culinary excellence. But if you replace the human element with high-efficiency equipment, does the product suffer?
Does the atmosphere suffer? People go to Chipotle for that fresh, handmade feel. If it becomes a vending machine because labor's too expensive, you lose your brand equity.
Totally. And on the brand pillar, they mentioned menu innovation, specifically the early success with a high-protein menu.
Is that their answer? Just target the gym rats.
It's a logical pivot, I guess. The health-conscious crowd is less price-sensitive. If you can sell a double chicken bowl for $18 to someone who sees it as fuel, you protect your margins better than fighting for the $12 value customer who has already left for Taco Bell. But it's a niche strategy. You can't build mass market growth just on the high-protein crowd.
No, you build mass market growth by building more stores.
Yeah.
And this is the part of the report that really just blew my mind. Despite flat sales, despite the traffic drop, they are on an absolute building spree.
He is aggressive.
They opened 132 restaurants in Q4 alone. That's more than one a day.
It's almost frantic.
Yeah.
They ended 2025 with 4,056 locations. But the statistic that really matters isn't the total count, it's the format.
The Chipotle.
Of those 132 new stores, 97 had a Chipotle.
The drive-through. This is a fundamental shift in their whole strategy.
Yeah.
We're not talking about those cool urban walkable locations anymore. They're hunting for suburban pads where they can just punch a hole in the wall and serve cars.
And it completely changes the unit economics. Digital sales are now 37.2% of their total revenue. The Chipotle is the physical manifestation of that shift. It's all about throughput and logistics.
But here's the risk. If I'm sitting in a drive-through line, I'm not seeing the food being made, I'm not smelling the grill, I'm just getting a bag through a window.
Yeah.
At that point, Chipotle is competing directly with McDonald's and Popeyes on convenience. And if their prices are higher because of those tariffs, that convenience better be flawless.
Yeah, that is the gamble. The report says Chipotlanes have higher margins, which makes sense, less dining room to clean, more digital volume. But you're commoditizing your own product. You're removing the theater of it all.
And if the food quality slips even a little bit, or those efficiency measures make the portions feel smaller.
The drive-through customer is the least loyal customer you have. They'll
Yeah.
just keep driving to the next window.
Okay, so while they're pouring concrete for these 350-plus new stores planned for 2026, they're also pouring a staggering amount of cash into their own stock.
Look at the buybacks.
The buyback number for 2025 was $2.4 billion.
It's a massive number. To put that in perspective, that's roughly 20% of their total revenue for the year, just funneled back into repurchasing their own shares.
This is where I get really critical of the strategy. You have traffic down. Your customers are basically saying, this is too expensive or I'm not interested.
Right.
And instead of taking that $2.4 billion and, I don't know, lowering prices to win back market share or investing in better ingredients, you just prop up the earnings per share.
Yeah.
It feels like they've run out of ideas on how to grow organically, so they're just engineering the stock price.
Well, the counterargument for management would be that they think the stock is undervalued and they're just returning cash to shareholders.
But you have to question the allocation of capital.
You do.
Yeah.
When your operational metrics are negative, aggressive buybacks often feel defensive. It masks the lack of net income growth. If they hadn't bought back those shares, their EPS growth would look significantly weaker.
So it creates an illusion of health for Wall Street, while the actual business on Main Street is struggling to get people through the door.
That's a good way to put it.
And that leads us to the outlook for 2026. Management's guidance was, well, honest, I'll give them that. They expect comparable sales to be about flat.
About flat is corporate speak for, we do not know how to fix the traffic problem this year. After a year of negative comps, forecasting flat comps means they're accepting this lower volume as the new normal.
They aren't predicting a recovery, they're predicting stagnation.
Stagnation.
And yet they're planning to open 350 to 370 new restaurants, 80% of them with Chipotlanes.
And that is the strategy in a nutshell. If existing stores can't sell more, they'll just build more stores to keep the total revenue line moving up. It's a land grab.
It reminds me of the subway expansion era. There's a point of diminishing returns. If you have 4,000 stores and they aren't performing, adding 400 more just adds complexity.
For sure. And they threw in a quick mention of international expansion, 10 to 15 partner-operated stores?
Yeah, UK, France, the Middle East. It feels like a distraction.
It's negligible. 15 stores against a base of over 4,000 is a rounding error. It shows they want to plant flags, but the engine is still North America. Specifically, the North American drive-thru.
So let's pull all this together. We're looking at a giant that generated nearly $12 billion. But the foundation is cracking.
It is. Organic demand is down.
They're using gift card breakage and massive stock buybacks to polish the financial statements. And they're battling tariffs and wage inflation by pivoting to automation and drive-thrus.
It is a company in the middle of an identity crisis. Are they a premium food brand, or are they a high-efficiency digital fulfillment company? The 2025 report suggests they're choosing the latter.
It's a huge bet.
A very high-stakes bet. They're betting that efficiency and convenience will outweigh the loss of that traditional customer experience.
They're betting $2.4 billion on buybacks and hundreds of millions on construction that the Chipotlane is the future. But if that flat outlook for 2026 turns negative again, if the economy gets worse and people cut back even on that convenient $16 burrito bowl,
then all this efficiency just means they can process a lack of orders faster.
that is the danger. You can automate the kitchen, you can optimize the drive-thru, you can buy back the stock, but you cannot engineer desire.
You can't. If the customer doesn't want the burrito at that price point, the most efficient Chipotle in the world is just an empty piece of asphalt.
And that is a final thought for today. We might have reached peak burrito. The expansion story is hitting the wall of economic reality. So next time you drive past that Chipotlane, take a look at the line. That line, or the lack of it, is going to tell you more about the economy in 2026 than any earnings report headline. Thanks for listening to The Deep Dive.
Take care.